Good afternoon, everybody, and welcome to today's webinar, Greenback's Comeback Sees Aussie Forecasts Drop to Low 70s by Stephen Dooley from Western Union Business Solutions. Today you are listening in using your computer speaker system by default. If you would prefer to join in over the phone, select telephone in the audio pane and the dial-in information will be displayed. You will have the opportunity to submit any questions to Stephen by typing them into the chat pane on the control panel, and they'll be answered at the end of the webinar. So now, a little bit about Stephen. So Stephen Dooley is the currency strategist of Asia Pacific for Western Union Business Solutions. Stephen's worked in financial services for more than 15 years. Originally covering markets as a journalist, Stephen later worked for a global institutional investment firm and made the shift into financial analysis. His role at Western Union Business Solutions is focused on helping staff and clients understand what's driving financial markets and how it might impact Australian businesses. Stephen makes regular appearances on Sky Business and has also been interviewed on the ABC's Late Line and News Breakfast programs. He has written regular columns for Melbourne's Herald Sun. Stephen has a Bachelor of Arts, a graduate diploma in Applied Finance, and is an accredited member of the Australian Financial Markets Association. With that said, I'll now hand over to Stephen. Thank you very much.
Thank you, Sabina. Appreciate that, and appreciate your very kind introduction. I can't wait to find out what I've actually got to say today. But as Sabina said, really we're looking at the shift that we've seen in the Aussie dollar over the first half of this year. It's been pretty significant when you think that we started the year above 80 cents. We got pretty close to 82 cents. But since then, we've turned sharply lower. Got down as low as 74 cents last week, and where we are now, just above 75 cents. So there's been a bit of a shift in expectations in Australia, and we'll look at what what's driven those changes and what it means for the Aussie US dollar over the next 12 months or so. We'll also look, being that it's only 3 or 4 weeks to the end of the financial year, we'll look at some ways to manage the risk that you do see in FX markets. Remember, the Aussie dollar on average moves 19% per year versus the US dollar. That's very significant. It can have a massive impact on your profitability. So we'll also look at ways of setting a budgeted rate that's achievable and brings certainty to your business, and ways that you can hedge to make sure you're able to achieve that budgeted rate. So I'd like to thank you all for coming along today. Very grateful to be able to speak to the members of APPA, and certainly Western Union, one of the largest financial services firms in the world, the largest non-bank financial services firm in the world. We've of course started off way back in the Wild West in the 1860s, helping put in the telegraph lines, and really we do the same thing now as we did then. We move information into areas in which it's hard for most of our competitors to do, and that's what we did back in the 1870s, transfer information. That's what we do now, transferring money. We're really glad to be able to work closely with APPA, and we began in 2017 working as a premium service provider, and really the partnerships for your benefit as members of APPA, and you get access to our risk management and insights, and certainly as a revenue opportunity for APPA as well. And we pay 3 years of rebates for every APPA member that becomes a client. So certainly in your interest and in APPA's interest for members of APPA to sign up. One of the other really important offerings that we do have is that unsecured credit line. It certainly depends on whether you provide us with your financials or not, or don't. But without the financials, we have a limited review and give you the ability to have a short-term credit line to certainly fund a lot of your payments. And one real benefit, in addition to all the other benefits of low transactional costs, very efficient and effective in getting money to where it needs to be, and of course the risk management advice that we provide here as well. But look, without any further ado, let's carry on. And really, financial year 2018-2019, the Aussie dollar's really started under pressure. And really it's been a case that we've seen a change in those expectations from the Reserve Bank. Now, when it comes to foreign exchange, the most important component in foreign exchange is the difference in interest rates between two economies. And it's been a pretty historic period for the Australian dollar. In March, the US Federal Reserve raised rates to a level above Australian interest rates, their new interest rate range between 1.50, 1.5 and 1.75, above Australia's interest rates for the first time since all the way back in 2000. So very significant, and that's part of the reason why the Aussie dollar's moved lower. But by far the most important factor is that we started the year with every analyst, the vast majority of analysts at least, expecting the RBA would raise rates this year, probably in November. But after some weak numbers from our jobs market, after some weak numbers from the inflation readings, all of a sudden that's been pushed out quite significantly. So no longer expect a rate hike this year. And just recently we saw ANZ and CBA both also capitulate and say they no longer believe we'll see a rate hike in 2018. So as I say, the difference between Australian interest rates and US interest rates, absolutely critical to determine the Aussie dollar's value, and the fact that the market now no longer believes the RBA will raise rates this year has seen the Aussie dollar significantly under pressure. But the Aussie dollar's big turn, really when we turned lower from that above 81 cents level, came back in February when we saw a big sell-off in global share markets. And look, partly that was driven by expectations for US interest rates, but in general, the Australian dollar is very closely tied to global sentiment. So when people feel good, when share markets are going higher, the Aussie dollar tends to go higher. When people feel more nervous, as they did back in February, that's when the Aussie dollar tends to follow share markets lower. So that's really when we saw the Aussie dollar lower, and hasn't been able to regain its mojo ever since then. So those two very big factors. And then finally, over the last couple of months, the US dollar has really stormed higher, and that's mainly driven by expectations the US Fed might start to raise rates at a quicker pace, and they're likely to raise rates tomorrow, and markets will be very closely watching the statement, the forecasts, and the press conference from Jerome Powell, the new Federal Reserve Chair, to work out exactly what his thinking is. And if his thinking is that he wants to raise rates at a quicker pace than currently expected, then the Aussie dollar could face some further heavy selling. And to have a look at how much that market has turned, here you can see the Aussie US really for about as far back as it goes. You can see when we floated the Aussie dollar back in December 1983, big move lower, so this is the last 40 years of price action. But you can see, one of the most simple technical indicators I like to use is a moving average, and typically in this blue line here is the moving average. You can see during periods where the moving average is moving lower, the price tends to move lower. As the moving average pushes higher, the price tends to move higher. Financial markets tend to be about momentum, and you can see that really throughout 2003 to 2012, Aussie dollar very much in an upward momentum. Since then, more of a downward momentum, and you can see the markets are starting to turn back lower now. You can see the very closely watched momentum indicator, the MACD, turning lower as well. So all of a sudden, the Aussie dollar really has seen a turn in sentiment. And we've had 2 years where we've seen a slow grind higher, but I'm afraid the dominant theme continues to be that the Aussie dollar does face risks, and even more so after the Reserve Bank of Australia continues to indicate they're a very long way away from raising interest rates in Australia. So that chart is the Aussie US chart, looking at a more broad basket of the Aussie dollar, and this is the trade weighted index, the RBA's special measure of the Australian dollar versus all major trading currencies, and you can see it's a similar story. And after a period of ongoing weakness since 2012, a little bit of sideways, but all of a sudden starting to move lower. This key momentum indicator starting to turn lower as well. So it seems like, again, after 2 years in which the Aussie dollar's traded sideways with a bit of a upward bent, it does seem like the risks for the Aussie dollar are for more losses. And certainly you can see for the moment out in the analyst community of those people working for banks and investment firms, where their views might be for the Aussie dollar over the next 12 months. You can see the top side target up at 85 cents. That's from BNP Paribas, French bank. And from the downside, you can see at 66 cents, Saxo Bank, where the larger Norwegian trading house. So two different views out there, and in general, as I said at the start, the Aussie dollar can move in about a 19% range, and that broadly does cover it, that 85 to 66 cent range. A little bit wider than average, but in a normal year, wouldn't be too surprised to see the Aussie dollar spend some time up near 85 and sometime back towards 66. It does tend to be a very volatile market. But as I say, going into the end of the financial year and the start of the new financial year, thought it might be good to see where the big four banks think the Aussie dollar will be at the end of the next financial year. So 30 June 2019. And you can see that the top forecasts are from CBA. CBA has been perennially a optimistic viewer of the Australian dollar, and their view for 80 cents at the end of June 2019. And then the other banks, NAB at 76, broadly where we are now, and lower, Westpac at 70 cents and ANZ back at 70 cents. So we talked about that range earlier from all banks, up around 85 down to 66 for the big four bank. A little more compressed, but similarly the same story, some higher, some lower, and markets are volatile. So we'll probably spend a bit of time around both of those levels. So certainly our view is that we're more likely to head towards those low 70s over the next 12 months. And certainly having a look at those charts, as we indicated, with both of them appearing to move back into a downtrend, the risk does seem to be to the downside. I mentioned at the start the one big factor in what's been driving the change in the Australian dollar has been those interest rate expectations. So here's a bit over 3 months, or a bit over 4 months ago, a bit over 3 months ago, back in February, you can see this is where markets thought we might go, and you can see broadly this is the Australian bond market, the yield curve, showing you when they think that the Reserve Bank of Australia will raise Australian interest rates. And you can see a slow grind higher with a belief we're probably going to see a rate hike around February or March in 2019. So that was just 3 months ago. And update that to today, 2 days ago. But update that, you can see it's markets far less confident. And in fact, all the way out till November 2019 when they think the RBA will raise rates. So think about the way that financial markets work. What do they look for? They look for the place you get your best return, and in foreign exchange markets, that's where it's got the best interest rates. And by now, US interest rates much higher than Australian interest rates. So anyone deciding where they'd like to invest does prefer the US to Australia. So that's what that means, that big change in interest rate pricing, and quite stunning to think that we haven't seen an interest rate increase since all the way back in the middle of 2016, and here we are 2 years later, and the market still doesn't believe we'll get a rate hike for another 18 months. So almost 4 years between interest rates moves. That's a very, very long time between drinks. So that's been what's driven the Australian dollar lower over the last 3 or 4 months. And as I said, a little bit to do with risk appetite, with global share markets weaker, a little bit to do with a stronger US dollar, but mainly it's all to do with the interest rates decisions that we're getting, or the lack of them, from the Australian market. So what does this mean for the Australian dollar? So here's the Aussie US over the last 4 years, and typically when a market has had a big move lower, like we saw in 2014, 2015, you tend to see a market move sideways for a while before the next piece of news drives the next move, and typically it is to the downside. So this just isn't in foreign exchange markets. This is typically how all financial markets move. They have a surge, a move strongly, a move sideways for a period, and they tend to see a continuation of that move. Of course, eventually they reverse, but then the pattern begins again. So broadly, the view from a technical perspective is that the Aussie dollar, as it falls lower and falls out of this big pattern, the risk is for the move to the downside. Particularly, as I say, it's going to be critical with the US Central Bank, the Federal Reserve, meeting tomorrow. And they're broadly expected to raise rates again tomorrow morning, and then probably one more time in 2018. If they do decide to raise rates twice more in 2018, that is the big risk for the Aussie dollar. The other big risk is a bit of a weakening in commodity markets, or further bad data from inflation or jobs in Australia. So certainly, my view would be the risk is to the downside. Our end of year target for 2018, 72 cents, and our target for the end of 2018-2019 financial year, the 30th of June, that target is 70 cents. So certainly more negative on the US dollar, but broadly in line with the views of Westpac and ANZ. So one of the biggest moves we've seen over the last 2 years has been the big move stronger in the euro and the big loss in the Aussie euro as well. And again, as we said earlier, all comes down to interest rates, and with the European Central Bank having printed money and pushed interest rates into the negative over the last 6 or 7 years to try and get Europe out of the recession that followed the GFC, that's coming to an end now. They're seeing better growth in Europe, and everyone's thinking about when Europe might start to raise rates. So that's why I've seen the euro so strong, and the Aussie euro found some support down here at that 72 cents. We've seen a little bit of a rally, but again, it's all about who moves interest rates first. There's expectation that the European Central Bank might begin to raise rates in the next 12 months or so. So everyone's waiting for the ECB to give that signal. So again, that's why the Aussie euro can weaken. And again, we've seen the Aussie euro really significantly lower over the last 12 months, from 74 to 62. A break of 62 is the big risk out there for the Aussie euro. So clearly one to watch as well, and one we're more negative on as well. Aussie yen, it's a similar story. The Bank of Japan, like Europe, have been printing money for the last 6 or 7 years. Interest rates below zero. That's caused a very weak currency, and that's why the Aussie yen got up towards up above 100 back between 2012, 2013. Since then, it's been more of a move lower, and you can see the Aussie yen particularly hard hit by that shift in expectations from the RBA, falling from near 90 back towards 80. The Bank of Japan probably will be the last to the party to actually start raising rates. So there still is a chance of a press higher in the Aussie yen over the next few months, but over the medium term, going into 2019, 2020, if the Bank of Japan does end its stimulus program, that's likely to see the Aussie yen weaker. I know that there's always a lot of interest with the Chinese yuan, with APPA members, with a lot of material being imported from China, a lot of payments increasingly being made in CNH. We find it's a really effective way for businesses to work well with their suppliers. They like being paid in CNH. It reduces some of the fat that they price into their prices when they have a US dollar price. And it also it can be as I say, a really effective way of building bridges with your suppliers. But the CNH, not a normal currency by any means, still very much driven by government expectations and government wants and requirements. And certainly for the moment, the Chinese government want the Chinese yuan to be stronger. They're trying to encourage more inward investment into China. As a result, you want your currency to strengthen. I mean, no one invests in a country where the currency is falling, because regardless of how good your investment is, you'll end up losing money on the deal. So that's why the Chinese yuan's been so strong recently. And again, we've seen that quite clearly in that move lower in the Aussie CNH. And we expect that to continue over the medium term. Aussie Kiwi is also a market that's very closely watched. And really at the moment, you can see a big sideways pattern for really the last 4 years, since 2014. And really, it just comes down to which country raises rates first to determine when that might happen. I joked that the RBA in Australia is unlikely to raise rates until November 2019. Well, the New Zealand Reserve Bank of New Zealand seems unlikely to raise rates until March 2020. So in both cases, this sideways range might continue for some time. But the caveat is that when one central bank goes, it's likely to be very explosive after 4 years of sideways motion. So potentially in the next 6 months, not much might happen in the Aussie Kiwi, but when it does happen, it will absolutely likely see a big, significant move. So that's the state of play when it comes to the markets. And getting onto the real meat and potatoes part of the presentation, with that uncertainty out there in markets, with the risk of the Aussie dollar pressing lower, how do you budget in the right way, and how do you hedge in the right way in financial year 2019? Well, first of all, setting your budgeted rate, this can set you up for a good year or set you up for a bad year. And certainly speaking to businesses, we've identified the best practices. Really, first of all, it needs to be competitive. It's a core component of your cost of goods, and it needs you to allow you to win business versus your competitors. So that's probably stating the obvious, but it sets the agenda about what you're looking to do. It needs to be competitive insofar as that you can continue to win business from your clients. But so that's the sort of the core of it. But it also needs to be realistic. It's all very well and good setting an incredibly competitive budgeted rate, but if you can't achieve it, then you've got the potential to have a major FX loss at the end of the year. That's something that if you're a CFO, you're accountable for. If you're a business owner, it tends to be less of an issue, but it still shows you that the budgeted rate isn't being set in the best possible way. So it needs to be realistic. So, for example, if you're an importer, say, well, if I price at 80, I'll be able to, have the most effective goods out there. But at the end of the day, that loss will come back and get you. So it needs to be realistic. So competitive, realistic, and finally achievable. So as soon as you have that budgeted rate in place, that introduces a risk into your business. And if you achieve better than the budgeted rate, that's a great result. If it's worse, well, clearly that's that loss being realised. So, you need to be also broadly achievable with what the current rate is at the moment. So, or what the rate is to be hedging. Now, for the moment, with forward points very favourable for importers, it's not so much of a problem. And the market at the moment at 75.5, broadly, you can probably cover your budget rate at 74 cents to the end of the year. So that's around that amount. So that's certainly makes it a lot easier at the moment. But these are the kind of tried and tested strategies that help you have a budgeted rate that's really effective for your business. So using those three components as your budget rate, That's certainly the way that we believe is best practice for businesses. What are some of the ways we've found businesses going about it in a way that's not the best achievable way? Well, first of all, forecasts. I mean, bank forecasts, they all vary widely. The vast majority of forecasters end the year with the wrong forecast. So how do you know that yours, the one that you pick, will be right? And as we saw earlier, the forecasts over the next 12 months go from 85 to the top side, 66 to the downside. So using your bank's forecast, that can be a strategy that does certainly add a level of risk that you don't necessarily need. And if there was a forecaster out there that was always right, well, they'd be on the news every single night. That isn't true. Historical rates. Very often we say, well, look at the average for last year. Let's use the average for the last year, and we use that as our budgeted rate. But FX valuations are driven by changing events, as we've seen. The average for the last 12 months of the Aussie US might be a certain amount, but the last 3 months have been dominated with the market changing their view on the Aussie US. So historical rates tend not to be the best way to manage your budgeted rate. Instead, as we said, use those 3 points: competitive, achievable, and realistic. But historical rates, not so good. And your gut, that's one of a favourite budgeted rate, particularly with some of our owner-operators that we work with, and everyone feels like they've got a pretty good grip on the market. But the unexpected in financial markets can happen very, very quickly, whether it be a change in economic data, whether it be a change in geopolitics, whether it be something unexpected that Donald Trump might do. It's been known to happen. So, again, your gut can often work well in business decisions. And don't get me wrong, very often when we talk about your gut, what we're talking about is, unconscious learning. So there's definitely an argument to you saying that your gut's great for making decisions in a lot of cases. But in financial markets, because the unexpected can happen quickly, it's a more thoughtful strategy to think about the risks out there. And as I say, come up with a budget rate that's realistic, that's competitive, but also achievable. So once you have that in place, it's a fairly easy step from there what to do next. And if you've been to our presentations previously, it's about that risk management program. And first of all, review your performance. How did you go last year? And then again, look at what your goals are. And we've already talked about that. You might have decided that your budget rate for this year is going to be 72. So your goal is to achieve 72 over the next 12 months, and then have that risk strategy in place to achieve that, and from there execute, and then go back to the review the performance. And what you might do is say, well, okay, what are we going to do for the new financial year? Well, for July, August, and September, we're going to be fully hedged, and you can probably get a rate above your budgeted rate if you're 72. Lock in an FX gain right at the front. You might decide to use that additional fat that you have in that budget rate to get an option, a participator that allows you to benefit if the market does move up to 85 cents, like BNP Paribas says. So, it's about having that strategy in place. But broadly, what businesses will do, they'll say, well, I'll be fully hedged for the first 3 months, so I know no matter what, everything that happens in July, August, September, I know what my cost of goods are, and I'm laughing. Month 4, 5, 6, in October, November, and December, you might say, well, let's hedge 30% of our exposure or 50% of our exposure. So if the market moves against you, you've got some level of protection. If the market moves in your favour, you can deal at a higher rate. If a deal drops through, then you know you're not fully hedged. You don't have the obligation. And then every month, you just continue to cycle through that. And as you use month 1, and month 2 turns into month 1, where you top up month 4 and you add month 7. And you just continue to do that every single month. And that gentle, ongoing process allows you to reduce the volatility caused by the Australian dollar, which moves, as we say, in a wild 90% range on average per year. That helps reduce that process. So, as I said just before, I jumped ahead of myself, but the hedging products that you might decide to use broadly make up to the forward, where that locks in the rate. So you book a deal today to pay 74 cents in 3 months' time, and that's the deal that you've got locked in. an option, whether it be a participating option or a vanilla option or a more complex structure, that broadly gives you a couple of different scenarios. And it might be in a participating forward, it might be, well, you're locking 72, that's your worst case rate. If the market goes up to 80 cents, then broadly, you'll be dealing around 77, 77.50 when that contract expires. So again, it comes down to your risk appetite and how much fat you've got in your margins. If you don't have the ability to give up anything, then you might look like a forward. If you've got some ability to give up some of on the rate, you might look to have an option. And if the market moves in your favour, you've got that ability to deal at the better rate. Or you might have a natural hedge. If you've got to pay US dollars in 3 months' time, but you're getting payment in 3 months' time for US dollars, well, then that works out as well. So hedging is just broadly about controlling that volatility and that risk, and it doesn't matter which way you do it. What's important is identifying the risk and then having a strategy to manage that risk. And so, as we say, there are numerous products all the way, and every business, certainly once we sit down and understand your business, it's fairly obvious which ones will work for you. It's not really a case of choosing what you want to use. It's more of a case of what fits with your business. So we're getting near the end of the presentation, but once you've got that budgeted rate and you've got that process in place, you really just need to think about these kind of questions. The hedge strategy, does it match my business? And you can use this for ourselves or any bank you're dealing with. Have I removed the market view from my hedging motivations? Like, don't say I'm going to hedge because it's going down. Don't say I'm not going to hedge because it's going up, because frankly, no one really knows. Am I hedging for the right reason? Again, protecting that gross margin, making sure you've got certainty in your cash flow, and does the hedging solution pass the stuck in traffic test? So if you do the deal and then you're driving home from work and you think, geez, what was that deal we did? That's a bad thing. So if you can't understand or can't remember the outcomes in that deal, it's probably too complex. And think about doing as in everything in life, the simpler the better. And then I'm happy with the final result, no matter what happens, because that's critical. Particularly some of the more structured product, there's a good result and a less good result. But if you've got a bad result, then maybe that's not the product for you. Let's try and stick with products that give you a good result or a better result, not a bad result. So, look, that's what we're certainly trying to do here at Western Union. As I say, understanding the uncertainty in financial markets, particularly the Australian dollar, helping with the right strategy in terms of getting that budgeted rate that's at the right level for you. And then finally, having your FX risk management in a process that's simple and allows you to concentrate on your business. And if the market moves against you, you're protected. If it moves in your favour, you're able to benefit. So really, we've been doing this for a long time. We've got the expertise, and certainly we hope we can able to help you. And as I said at the start, remember, with our partnership with APPA, if you sign up with Western Union, we've got great rates and great deliverability in any case, but it's certainly some of that revenue flows back to APPA and helps the organisation, and we're really keen to continue to help support APPA. So I'd like to thank you again. I'd like to thank Sabina so much for helping today, and I'll pass back to Sabina for the balance of the session. Thank you, Sabina. Or maybe I won't. We might have had a dropout over there. But if there are any questions, feel free to just pop them in the chat service. The box at the bottom of the little go-to webinar control panel, and we'll be able to more than happy to answer any questions. Well, it looks like there's no more questions, of course. If